welcome to our weekly live stream recording of the M&A Zing, a podcast series devoted to acquisition entrepreneurs, search funds and holdco builders in the UK and EU, discussing the topics and challenges that impact S&B succession M&A and exploring the highs and lows of searching, acquiring, owning and operating small and medium-sized businesses. I'm joined as ever by my illustrious co-host, Gareth Hawkins, serial acquirer, CEO of BizCrunch and all-round font of acquisition knowledge.
Yeah, I think if I was a font, I'd be sans serif. Yes, what a letdown. You've got me. Yes, our guest is postponed. Ghost busted it, Freudian. But yes, tune in next week for a thrilling adventure there. But we are, we're here to talk about due diligence, do's and don'ts. Key topic for most of us doing acquisitions. What do we need to look at? Where do we need to spend our time, etc.? But I guess before we dive into that, we should talk about stuff that's happened this week, Alfie.
Yes. Well, if you hit us off, Gareth, I believe you've got some interesting news from Italy.
Yeah. I like it when we can bring news from the wider European ecosystem. And Italy seems to be spawning new traditional search funds at a rate of knots at the moment. The fifth to emerge in recent weeks is Nostos Capital, which has just closed its raise. It's founded by Francesco Valli and counts illustrious search fund investors on its cap table, among which are Visconti Capital and Search Capital Partners, both of Italy. Search Capital Partners is in Milan, founded by Giacomo Andrioli and Luciano Avanzini. Those guys are very well experienced and are becoming quite prolific on the scene over in Italy. But we're wishing Francesco Valli well now that he is beginning his process of finding the acquisition targets he wants to bring over the line to build his platform. So well done for the close, Francesco.
Exciting stuff. Yeah, like you said, there seems to be quite a lot coming out of Italy at the moment. It's a real sort of hotbed for search funds at the minute.
Yes, I think it's a symptom of the emergent kind of nascent scene of search around that Mediterranean area. As we know, Spain has been a big progenitor of the search fund movement, probably second most only to the US. So it's unsurprising that it's spreading through those Latin countries at the same time as it's gaining momentum here in the UK. So yeah, watch this space for more, I think.
Interesting stuff. Well, my news is from the other side of the pond. So Calgary-based Rumi Capital, led by Parsa Samavati and Saurabh Dutta, have launched a cohort of their graduate program, which is super interesting. So they're taking on 10 ambitious acquisition entrepreneurs to help them sort of find and operate and acquire businesses in Canada. And really, it's an incubator for search funds, which I think is really cool. We've spoken about this a few times about how, search funds are so important to this ETA movement because search funds spawn more acquirers, but they're spawning more search funds, which is brilliant. Absolutely brilliant. Yeah.
So they're incubating these interns, these graduates who have come out of sort of, I guess, an MBA program and now are hungry to get stuck in to acquiring companies. But Rumi are sort of, I guess, preparing them, arming them, capitalizing them possibly even to go and do these deals?
It seems so, yeah.
That's really interesting.
Super interesting. Led by a great team. I know that you've been following them for a while, Gareth, so really excited to see what comes out of that.
Yeah, me too. Are you familiar with Coniston, who I think have done a similar thing? Maybe we'll talk about those in a different episode. But yeah, really interesting that those guys. Yeah, that those guys have been busy doing that. Cool. Okay, well, we're back to Europe then for the final of the three news items for this week. Let's talk exits. It's always nice to hear of a searcher getting the culmination of their journey. In this case, it's an 8-year journey for Joaquin Pardo of Sina Capital. He acquired Vositel back in 2017, 2018, I think. Okay. It's a call center solutions company that he's just managed to exit and sell to Everfield, who are a buy and build vehicle that have basically got a platform that they're tucking Vositel into. But who says a fund cycle is 5 years, eh? Herculean effort, no doubt, on behalf of Joaquin, but he's got there, he's done it, and hopefully, as we often see is the case with exited entrepreneurs, that capital, that wealth event, normally gets put to good use in capitalizing the next era, the next vintage of investors. So certainly not like trying to obligate Joaquin, but I'm sure he'll be paying forward his experience in one way or other. So congrats, Joaquin, for your exit, and hope that maybe we could even get him on to talk about it at some point.
That would be fantastic. We'll have to reach out to him. And yet, once again, you know, Spain sort of leading the charge in Europe again. It is amazing. I love to see these sort of success stories and exits. You touched on something really interesting there, actually, that they often do get rolled into new ventures. It's something that I really love to see in ETA. Do you think it's a sort of we don't often see people taking their cash and running sort of thing? Do you think there's something sort of addictive about it? I think once you're in it, it's probably hard to extricate yourself from it.
I mean, it's the parallel there is, you know, exited tech entrepreneurs in the venture scene that are then becoming LPs into VC funds or are prolific angels. Yeah, I think, you know, once you understand the space and you've had direct experience in it, you feel you can navigate it well to make some good investment decisions, but also allocate capital and advice where you think you can make the most impact. So, I mean, Chris Adelsback's a great example of that in the UK angel scene. He had a great exit from his tech startup, which then I think he's been prolific as like 200 times investor, 200 portfolio companies in his stable. And he's so well regarded, well liked, well respected because he gives his time and his knowledge and his experience and his guidance, as well as making his investments with capital. So yeah, I do think there's some parallels. Simon Webster here in the UK obviously was the OG of search funds outside of the States, or, you know, back in the day. He, having gone full circle with an exit, has become a prolific search fund investor and backed the new vintage of entrepreneurs. So yeah, we do see it. There are progenitors, there are examples, and long may it continue. You know, we need that perpetuation of capital in order for these spaces to continue to flourish.
Absolutely, well said. Okay, with the news wrapped up, it's time to get into this week's topic, which is a bit of a tongue twister: due diligence do's and don'ts. This is something that I think a lot of first-time acquirers can be a bit nervous about. I think if you haven't been through the process before, the idea of kind of knowing what to look for, you know, what's a red flag, what should scare you off, there is just quite so much to dig into. And it's something that I know very little about. So this week I'm going to be interviewing you, Gareth, and I'm going to ask you lots of questions. I'm going to pick your brains because you've been through this process. I mean, how many due diligence processes have you been through?
I've been through 8 on the buy side, plus a slightly accelerated one when buying a company out of liquidation, and then 1 on the sell side. So 8 on the buy side, 1 liquidation pre-pack, and then a sell side process. So yeah, seeing both sides of the table can hopefully attest to what can be a deal killer, or where to focus your time and effort. Because I think fundamentally, the clock starts ticking and the meter starts running from a legal cost and the advisory cost perspective. The moment that data room kind of gets shared and you're in and having to, against the clock, if you like, work out whether this is a good as idea as you thought it was going to be or not.
As the case sometimes is. Okay, well, look, let's start with the very basics. For any first timers out there, what exactly is due diligence? You know, in the context of SMB M&A, what is it and why is it quite so crucial? Yeah,
really good point. I mean, I think there's 3 moments of big boy pants times when in a deal, right? When in your M&A journey, we go out there with the lofty idea and the dream of getting a deal done, and then it gets real when you are agreeing the terms, the heads of terms, that handshake, that moment where you've got the countersigned HOT back and it's like, right, game on. That's big boy pants moment 1. I would say moment 2 is when the VDR opens and you're managing the share purchase agreement coming at you in red line terms back and forth from the lawyers at the same time as you're trying to make sense of this sea of documentation that you've requested. And really get digging into looking for the sort of hidden liabilities in amongst all that. So due diligence is duly being diligent about checking through all of the necessary documentation and records and financial results and ledgers and all of the things you need in order to have a very cogent understanding, in order to have comfort that you can then sign the SPA and execute the deal. This is your moment to determine the reality behind the sim, because you're going to read all the puff, you're going to hear about all the possibilities and all the potentials, but only when you really get into the weeds with this and start, lifting the rocks and looking underneath and opening the cupboards and looking for the skeletons, are you really going to get to know the real business? Flippantly, I say the real due diligence begins the moment the SPA ink is dry and you own the company, because that's when you really know what you've got. But you want to try and avoid that, and you want to do as thorough a process as time and money will allow before you're committed and there's no going back.
Absolutely. And I think that is what scares people about this process is, what am I going to find out afterwards? If I do not do a good enough job in the prep and the due diligence stage before the SPA is signed, what am I going to leave myself with?
Exactly.
So hopefully
that leads you to the third big boy pants moment of I own this company now. The SPA ink is dry. I've got to go and stand in front of a room full of people and say, here's what's happened. And hello, I'm here for your future. And we're wedded together now. It's often much easier to do that if you are doing it from a position of confidence and knowledge than it is, well, at the same time, you're filled with trepidation about taking a leap into the unknown. I'm not going to quote Rumsfeld, but it's better to have some, control of the situation. So due diligence is good preparation, really, for that moment.
Okay. Well, that leads me on to my next question. So anyone who's kind of looked at this subject before and had a cursory look will see that there's different types of diligence. So, we hear about financial, commercial, legal due diligence, sometimes even HR or tech is becoming increasingly important in the process. Which categories do you think matter most for the smaller deals, and why?
Really good question. Obviously, I'm going to couch it with it's very dependent on the business, both its size and its type and sector. So if you're buying a software company, of course, that tech due diligence is paramount. What are you buying beyond hopefully recurring revenue? What actual innovation have you bought? Is there proprietary IP, or is it just a nice looking UI built over a lot of other people's stuff? Hopefully you would know that before you're offering, but this is the tech audit, tech due diligence is a way of finding that out. Also, that will tell you how scalable, etc. that is. So I'm gonna not say a lot more on tech, but there are some great specialist companies who typically they're adjunctive to developer agencies who will do that tech audit for you. Will get into the code repositories and tell you if the product looks to have been put together, engineered properly, or is held together with duct tape. You have to tread a little bit carefully there. Obviously, you're under NDA at this point. Software companies are loath to share the crown jewels during a due diligence phase. So don't be surprised if a number of them are sort of restricting access to really delicate stuff. Do press and push as much as you can to get sight of it, but remember you are duty bound to respect it, and if the deal falls apart, delete any reference to it. That is one of those trust moments where you're letting people spider across your code as the seller, and hoping to the saints that this actually completes as a deal.
Yeah, you're really putting a lot of faith in the NDA there, aren't you? Because you don't have any other solid commitment on paper.
I've heard some pretty bad stories about
I can imagine
malpractice there. So let's hope that you found a level of trust and you working with somebody that is decent when doing that. So that's all I'll say on tech. Tech can be fundamental in a software business. It's secondary in a lot of the more traditional SMBs that perhaps we're talking about in this context. So if it's a small business, which a lot of these will be, we're talking potentially maybe a couple of million EBITDA at most. It's going to start with a few, universal truths, universal fundamentals here. People. So what does the org structure look like? What's the length of service, the tenure of these people? Also, whilst you're looking at length of service, you're going to be calculating what your liability is in the event of a redundancy process. So you really want to be able to see anonymized and GDPR compliant lists of roles and salaries in that roles and tenure in those roles, so that you can calculate your potential liability there. But also an org chart. The spreadsheet of roles and costs means nothing without an org chart showing the fixed lines and dotted lines of communication. So you can actually assure yourself that it isn't just a whole bunch of headless chickens running around duplicating effort. It's people who are, structured in the way they go about their day, and there's some clear responsibility and lines of communication. So I probably spend a disproportionate amount of time looking at people, but that is a fundamental thing to try to get to know early. Second to that, obviously, what's the supply chain and value chain concentration risk? So you want to be seeing potentially, again, an anonymized list of customers and suppliers, vendors. So like how exposed to a small number of customers, for example, is this company? So I like to see a table which shows me like their top X, potentially top 50, because that's a nicely diversified risk. But at the very least, what does your top 10 account for of your total revenue? If one customer is accounting for 25% of your business, there's a risk that, particularly with like change of ownership clauses in contracts, is there a big exposure that company, that customer could say, oh, well, we've got this, we're going to exercise our right at this window to explore our options, and bang goes a quarter of your business, right? So I think key risk mitigation around customer concentration, and again on vendor concentration. If someone's holding you by the short and curlies on the supply chain side and can choke you off, that could be a real risk that you can't continue to trade. So again, have the seller already got like a panel of suppliers that they can switch you to in the event that one becomes a bit sticky. So customers and vendors, really worth exploring.
Okay. On that, just before you go on, again, someone hasn't been through this process before. Is this something that you're quite comfortable, and acquirers should be quite comfortable saying to the seller, look, this is what I want. I want it in this format. I'd like them anonymized. I'd like the top 50. Is that something you'd advise? Just going out there and saying to the seller, I want this as part of my due diligence.
Yeah, absolutely. It should be on your list. I mean, I always kept a sort of spreadsheet checklist, if you like. I think it's probably about 200 rows long of the sort of things I'd like to see and the sort of things I expect to be in a data room. Often a buyer will share that list. These are the things I want. And yes, definitely be asking for that. Is it going to be forthcoming without asking? Probably not. Not unless this seller has been through the process before and has been asked these questions already and already prepared. But yeah, it's definitely worth asking for. I assume everything that I'm going to touch on is stuff you should ask for if it's not forthcoming.
Okay, sure. And also, again, customers and vendors, two super important things. Is this something you would expect to have a dialogue with the seller about? Maybe for some more context, how many of those relationships are dependent on the business owner? And that increases the risk of, perhaps losing that vendor or losing that customer. Is that another sort of part of the DD that you would go through?
Yep, 100%. What's the relationship like here? This is more of a verbal conversation with the seller about like, how long have you known these people? Are they the sort of supplier that, when you go over to see them, they invite you into their house, and are you, known to the family and all that sort of stuff? Because you want there to be a tie between the businesses, but you also don't want to be the only tie between the businesses to be the individuals. And when that individual is removed from the equation because they've sold, that relationship might break down. So if it's a strong commercial relationship between the stakeholders, that's always better. Oh yeah, my people deal with their people, and we go way back, and that's enough for me. Like, show me a contract, make sure that they're not going to pull the rug out from under me, and I'm happy.
Okay, excellent.
Then we should get into IP. So we want to know what kind of patents or trademarks or design rights they have, written or unwritten. What are the barriers to entry to competitors that might want to spin up or colleagues that might want to go away and phoenix a company as your competitor, which often is the case. What's going to stop them from an IP perspective? So that's useful. and also make sure that the business owns the IP, that all the trademarks, etc., aren't owned by the seller individually and walking out the door with the seller. You really want to do a bit of an IP audit and make sure that domain names aren't registered against the seller's personal credit cards. And I've seen that stuff happen before. It's a lot to unbundle post-deal when the seller's in the wind or in Barbados. And you're like, oh, could you just get into your GoDaddy account for me? And it's dirty. You want to get that stuff all done pre-deal. Really, it goes with the company, right? Don't want to be held to ransom at a later date. So all those aspects of IP, brand, and brand assets, products and services. You'd like to know a bit more about them, obviously. So if there's certification around a product or there's accreditation around the engineers or the staff in a service company, you want to make sure that all of that stuff is compliant, all that is done by the seller. That they're not just lapsed on a particular approval, and you're going to have to pay 10 grand to go and get this reapproved on day one because they swung the lead. Those things attract a risk. So you want to make sure that from a compliance and a certification perspective, that what you're buying is safe. It can't go on without having mentioning financial stability. Obviously, financial due diligence takes up a lot of time alongside legal due diligence. We'll get into those two, I think, specifically in a moment, because that's where you want to have some support. But that quality of earnings, financial stability study is key, as is the legal due diligence of going through all of the documentation that you're going to get populated. So employee contracts, customer contracts, supplier contracts, leases, hire purchase, all this stuff. We're looking for the gremlins to see if there's a liability there. So I think probably the final two that are on my checklist normally are governance. So can I see some previous board minutes, for example? Who's responsible for compliance in a regulated industry? What can I see as regards their track record and their certification, etc., their education, their background? Who am I putting my faith in there? So if there's records that show good governance, then that should be in the data room as well. And slightly less easy for the seller to come up with, but something that you should try and commission if you can, or that potentially if you're working for a broker, they might have already done for you, is a market study. So what kind of information have you got about competitors, like in context with the seller? How can you verify market share, for example? Can you see data that tells you whether the market is growing or shrinking? Sometimes sellers have prepared that as part of their process. Other times it's probably incumbent on you to just reassure yourself, probably even before you've actually made an offer on the company, that this is a market that you want to pursue, that you want to be in, and that it's a market that this particular company has upside in.
Some of that work should have been done, in advance. I mean, potentially even when you're choosing what type of company to go looking for. It's one thing that we've advised users to do is, look at markets where they can see opportunities for growth, etc. But obviously, when it comes down to the actual company themselves and the data that they would have, I mean, is that something that you would bring someone in from the outside to do?
There are companies that specialize in doing specifically that. I mean, be cautious. A market research company is going to want to charge you a lot of money to do a very thorough exercise. There are probably some low-hanging fruit things you could do, which maybe we can get onto in a little while.
Well, yes, that does lead me on to my next question. So the next point is assembling your due diligence team. So, from accountants to legal counsel, who do you need on your diligence squad, and how do you decide what you can DIY and where you need that professional help?
Yeah, definitely both of those. I would say a deal team minimum squad should involve a financially competent, experienced, qualified strategic accountant, right? You need somebody that can dive into the Xero or the QuickBooks or whatever and tell you where things have been awry, or where things have been done really well, for that matter. That's always good to hear. So definitely a strategic accountant or someone that knows how to navigate ledgers well and piece together the true story. And you're going to have a lawyer on your team. Lawyers aren't just there to produce the documents for you. Yes, they're going to be going back and forth doing the terms of the share purchase agreement, but you depending on the size of the transaction, you may have a sort of junior associate or something there that is going through the data room and actually reading these documents for you with a critical eye for detail that is looking for liabilities, like, oh, hang on, this contract will cease to be relevant when the incumbent no longer owns the company, for example.
Sure.
Or, hey, look, there's a huge bullet here on this lease that, or this building lease is actually overdue on its break clause, and the landlord could kick you out at any moment. These are things that you want to turn up in due diligence, because they all have a bearing on. I mean, I acquired a business some years ago, which we could never have seen it coming. But pretty much as soon as the ink was dry on the SPA, they got a compulsory purchase order from the local authority.
Oh, no.
Booted them out of their building, and it was because they wanted to build a retail park on the building that they had occupied for almost 100 years. My luck, the day one that we acquire them, they get this notice, through the post from the council. Yeah, we're redeveloping the site you're on.
Oh no!
Yeah,
I mean, did all end well with that?
Yeah, fine.
Okay.
Yeah, but it expedited the relocation. Let's put it that way.
I can imagine. Yeah.
Yeah. So you'd love to see that coming, right? So you could even have some folks poring over like local plans, like on the local authority's website to say, look, are there earmarked sites in and around where your business is operating from? Is there a risk of that? That's not insurmountable. But if you're buying a shop with a high street location and it's entirely about that, like people go there for, are they going to follow the shop when it moves to a out of town location, for example?
Yeah, I think that there can be a temptation. Look, there are a lot of sort of scrappy acquirers who want to do it themselves, and they want to DIY stuff to keep costs down. But the cost of a lawyer to go through that for you is a lot less than the cost of having to relocate in your first week.
Yeah. That's a balance. Like, and a lawyer will obviously tell you that you should do the most thorough process you possibly could. That takes months and months and months and goes into every conceivable preemptible permutation. You got to temper that, mitigate that with cost and reality, and make your own. I mean, we'll get into it in a little while, but you should have your own rules for how you want to run this and how far you want to let it grow arms and legs.
Yeah, we don't want to get into deal fatigue, which we'll talk about in a little while.
Okay, so I would say, go ahead.
No, please finish.
I have finished. It's just, I would say your deal team is you and people that are in your close-knit community that are part of this process. You'll need some additional pairs of eyes to go through and check things. That's either going to come from lawyers you pay for or people that are in your camp, and good numbers people, and possibly a market study. And you could have an HR person look over the org chart and cultural indicators about the company if you are particularly concerned. But I can't name more than about 2 acquirers I know that have gone to that depth.
Okay, interesting. Okay, so something I wanted to ask about, which I've kind of heard about a few times, and we kind of touched on this a little bit earlier when we were talking about having a good strategic accountant. But what's a quality of earnings report? So how does it differ from the basic financial review, and why? I mean, I can understand how they could be a deal breaker, but what is the kind of the difference there? Where do they go into that extra depth?
Great question. The Q of E is all about sustainability and durability of revenues, right? Ultimately, and are the costs in servicing those revenues realistic? Have they been massaged? Someone might be citing a huge gross profit, but actually they're misaccounting for where the overheads go, for example, and stuff should be put in as a cost of sale. And if they did it properly, actually the gross profit is far less than it's being advertised at. But it's really the sustainability and durability of the earnings of the company, driven by the revenue and the costs. Am I going to continue to get this revenue, or has it been cooked up in anticipation of selling? Like, has somebody really expedited and pulled forward lots of stuff into a year, and then it's going to be fallow for the next few years when I'm cash flowing it? So you want to make sure that this is a sustainable, ongoing business, and it's not just getting out at the top of the curve before the arse falls out of it. So there's that. There's also looking at other calls on cash flow as well. So getting into a proper exercise within the Xero or QuickBooks or Sage will tell you what goes on beyond the P&L, Like, are there some serious sort of ongoing calls for cash that are happening at the balance sheet level that can undermine your ability to serve the working capital you need to get your P&L going, or keep your P&L going? So that is fundamental to a quality of earnings. Is it sustainable? You're looking at customers, you're looking at repeatability, you're looking at recurrence if you're a software firm. Like, if we break these down, are these coming from a small number of customers and we don't have a great deal of recurrence from the majority of our customers? Because that creates a vulnerability if you do. So you're really trying to get an understanding of the beating heart of what is driving the earnings in the business. And that's forensic, really, because you could be taking it as read just by looking at the sort of high level retrospective ledgers, or you could be looking at how the company plans and how and the contracts they've got, and the sort of heuristic indicators, if you will, in the P&L that tell you how it really played out, because you can spot like a massaged you can spot like an artificial surge in demand if you unpick it and go back and look at customer behaviors and start asking questions about, well, that customer in the 4 years prior spent 20% of what they spent in that year before you advertised it for sale. Why? Oh, it turns out they sold them the next 4 years worth of service up front. But rather than put that through the balance sheet as unrealized revenue, as a liability, they've just put it through the P&L as revenue, but haven't yet delivered the service. So, you right. can, that's a common trick of, let's pre-sell a whole bunch of future years worth of revenue, get it in this year, but then you should have an equal and opposite liability on the basis that you might have to give it back. But, some folks selectively forget to do that. So Q of E can help you dodge those kind of bullets.
That's so interesting. I didn't know that was such a common issue. I can totally imagine that happening. Okay, so that leads me on to my next point. We're talking about dodging bullets, red flags, and deal killers. So you said that can be quite a common issue. Bringing those orders forward. But what are some other common warning signs that emerge in due diligence? How do you distinguish fixable issues from deal breakers?
Yeah, you would hope that by the time you've got this far, you have a reasonable appetite for risk and a reasonable understanding of what the fires are likely to be burning under the business. Mm-hmm. And most of those fires could be easily extinguished. It takes quite a lot to bring a business down, but incompetence is a key reason often. Mm-hmm. But so you're really looking for the hospital passes, right? I'm a rugby player, so you're looking for that. Someone's passing you the ball just at the point that you're about to be pummeled.
So I didn't know that term. I like that.
Yeah. So that one, like, there's the pass that you don't want to receive because you're about to get your head knocked off. But ultimately, this is what you're looking for. Is, does the seller know something I don't about why this is a good time to step out?
Sure.
Are its best days behind the business? Is there a looming cliff that it's about to fall off of? That's what you're trying to work out. Am I going to hold the bag here and find that the bag's got a gaping hole in it, and by the time I've taken 2 or 3 steps, it's spilled out on the floor and there's bugger all left?
I suppose, we talked on one of the previous episodes about, looking for motivated sellers, but sometimes there's a shadow to that motivation. Yeah, right. Yeah.
Yeah. So, most things are solvable, but those irrecoverable things, that's like irrecoverable decline being masked by a moment of, like, we've created this veil of success, but actually underneath is a house of cards. Like, that's what you're looking for.
Okay. And in this process, how cooperative should you expect a seller to be during this due diligence? I mean, look, as an outsider looking in, you would imagine that they would be as upfront as possible. But, the more that we talk about this, the more that there are a few sort of dark ice patches to slip up on. So, yeah, how much could you expect them to share with you?
I mean, you could distill all of this down to a test of the seller's integrity. Right.
Yeah.
That's ultimately what this is all trying to determine is, can I trust these folks? You would hope that this hasn't just been a big artificial kind of con. You would hope that they've been truthful throughout and candid throughout, and normally you can get a good feeling, if you're into your neuro-linguistic programming and you're looking at where the eyes go, the furtive glances and the pauses, then you get a good feeling for whether this person is being honest in the moment. But it's when you start asking for things and asking for things that haven't been provided, that transparency, as you rightly call it, is probably the thing you're really looking for. For me, that's the biggest red flag. Like if there is a reluctance or an unwillingness or or the bullshit machine kicks in and there's lots of verbiage coming to try and cover up what you've just discovered, and they don't really want to confess to what you've just discovered, then actually you might be dealing with a liar or a hoodwinker, and it might well be that hospital pass that you don't want, and that's probably the time to walk away.
Yeah, so I'm guessing that's quite a big red flag. If you're asking for some, crucial documents, you're asking for some information, and they are, avoidant and giving you a whole heap of excuses as to why they don't want to pass that over to you, that's got to be a big, glaring red siren more than a flag to say, it's time to walk away.
That's the moment when, or at least it's time for the adults in the room discussion. It's the time when you sort of, sit down, level with me. Come on, our due diligence has discovered this. Could you tell me a bit more about why that might be? What's been your experience here? Have you seen this before? Did you know it was coming? Like, have that, mature peer conversation. I don't think it's a moment to castigate anybody unless you hold the ultimate cards here, because if you don't have comfort, you are not contractually obliged to go through with this deal, right? Heads of terms are non-binding. So the due diligence is really at the seller's risk. And if they're not forthcoming, you can just pick up your stuff and go. So I think, have that adult conversation. If you're not satisfied with the response, dig deeper. It will either lead to that relationship breaking down, or it will lead to transparency. It may lead through that transparency and that sort of moment of resignation, if you like, on the, okay, look, the gig is up, seller's got to come clean, and here's the real deal. That actually is a moment potentially to renegotiate. So we can come on to that, but like it could be an opportunity if it's not a deal breaker.
Yeah, absolutely. If it's not something that absolutely has to kill the deal, then maybe it's just time for renegotiation. Okay, so this does kind of neatly lead us on to my next point. Throughout this process, time management and deal fatigue. So due diligence can obviously drag on. And as we're talking about here, if there are slowdowns from the seller and any kind of reluctance, even if there isn't, there's a ton of paperwork to go through. There's a lot of back and forth. Maybe we want to talk about renegotiating prices. And as we talked about in a previous episode, the kind of build up of all of this can lead to deal fatigue. And as the man himself, Walker Dybel, says, time kills deals. So how do we, what are the practical tips for keeping the momentum going? How do we ensure that we're still reaching those key details, but without dragging this on to the point that we're jeopardizing everyone's sanity and the deal itself?
Yeah, I think have that contracting agreement up front, have that discussion about we'd like to get this done in, all things being equal, and set a target date. It can move, but you set a target date. Everybody gets round, gets behind the 8 ball on that one. So I would set granular kind of milestones along that journey and say, I'd like to have this, VDR populated by, and first pass of the SPA by, and we'd like to have, answers to our first round of questions from the VDR by. So you can break this down into a logical kind of like cadence. I think it also helps, particularly with your home team, in fact, perhaps only with your home team, to agree on a materiality threshold. So like, your lawyers will look for everything, your accountants will look for everything. By all means, find things, but let's agree there's going to be a materiality threshold of things we're going to want to fix in aggregate, right? And if we tick over this threshold and suddenly there's, there's a jeopardy to the deal to the tune of like a third of the deal value of stuff you've uncovered, right, probably time to call it. But if you found me stuff that's cumulatively only like 0.3% of an impact on the deal value, maybe we could just deal with that later, because it's not disrupt the deal, keep the momentum going. So I think it's important that your team know your risk appetite, know where your red lines are, and know that the focus is on trying to get this deal done by a certain date. Calls help. So calls both, well, certainly I think it's always good to put the home and the away team together on a call just to account for their progress. Initially, that can be fortnightly. As things get nearer to deadline, that becomes weekly, possibly then twice weekly, about an hour at a time. Just going through, these are my obstacles. This is, it almost feels like a software development stand-up, right? These are the things that I need to knock over. This is what I've achieved. These are the things I need your help with. So those calls can be really useful, but it's no more complicated than that. Set expectations, understand your risk appetite, and communicate.
On the point of materiality and risk appetite, I think that's a really, really interesting point. One thing I find really interesting is if we compare startups to acquisitions, as we do obviously in this ETA movement, when you found a startup, you go into it knowing that only 1 in 10 succeed, and people take that risk on and they say, it's not going to be me. You have to obviously be confident of yourself in that sense, but you go into it knowing that there is that big risk. So you wouldn't expect there to be zero risk when acquiring a company, or you shouldn't, I think. I mean, obviously, you have to set a threshold for that, but to go into this and expect it to be 100% airtight, I think is probably a little bit naive.
Yeah, you need to have a bit of a war chest, or at least some headroom in the working capital of the business you're acquiring to weather a storm. And storms are inevitable, right? So I think you have to be realistic about it, and just deal with the punches as they come.
Yeah. Okay. Well said. Okay. Next topic is one that I've been looking into quite a lot recently, and trying to learn more about is data rooms and organization. So perhaps not the sexiest topic, but a really important one nonetheless.
What do you mean a data room's not sexy?
I mean, to some people they aren't. To me they are, but that's what I do.
I'd rather read one of those.
Okay, well, let's get your rundown on that then. What does an ideal data room look like for an SMB acquisition? How do you, again, we go back to that same point, how do you make sure that you're hitting all of the right details without drowning in unorganized paperwork, asking for more than you need, slowing down your team who are having to read through all of this stuff? Where do you find that balance?
Probably asking somebody here who errs more on the side of I'd rather have it and know it than not to have been told it, right? So less is definitely not more for me. I think okay. more is more, and just having the proper resources to devour it and summarize it. And of course, look, we live in an age now with ChatGPT and other LLMs and stuff that can do analysis and surface key salient points at a rate of knots. I personally think M&A due diligence is going to be transformed over the next few years. There's already like a number of tools that are emerging to do this. The challenge there is obviously making sure you're not giving OpenAI all of the VDR and contravening your NDA. But my point is, get the information, have the resources to summarize it. A prepared seller with a comprehensive data room, maybe someone that's been well coached, well advised, with a good advisor, or have been through this process before, they can expedite a deal timeline. Like if they've got all the stuff where it should be in a sort of logical order, then that's a dream because you can get stuff done early. What slows you down is having to ask, having to wait, rinse and repeat. That's so super time consuming, and often obviously that's costly because you've got lawyers on retainer during that process. So I think you can preempt the problem by sending your checklist and saying, these are the things I want in the data room before, like early, like at heads of terms agreement, right? Okay, before we even get the lawyers to meet each other, these are the things I want. Here's a data room, a link. Yeah, go, Mr. Seller, populate that. Not just a Google Drive. Make sure it's a robust one that's properly organized with an audit trail and all that sort of stuff, because post the deal, that's going to matter to both of us. But yes. Populate this with these things, please, and then get into the work of having to unpick them and read them and summarize them and look for the gremlins. So it's an important part. You can't shortcut it, and it will be proportionate to the complexity of the business, but you can certainly get the other side to prepare early for it.
I feel like with all this talk of gremlins, we've got a kind of BizCrunch mascot sort of cooking up in the background here. Sort of.
Just don't feed it after midnight.
Going back to your point about LLMs and due diligence, I can totally see a kind of marriage of a human in the loop. Obviously, you wouldn't cut out your advisors and legal team, but that going through the mounds of paperwork and looking for, certain points. I think obviously you don't want to feed everything to ChatGPT, but an LLM with a well-trained vector database that knows about due diligence, I can totally see that absolutely transforming the way
it's coming.
work.
There are already tools that are emerging for this. It's a wonderful time to be alive, frankly. Really is. But I see AI as an enabling technology. It will augment the humans. It will supercharge their productivity. That can only be a good thing.
Yeah, I that's always my case with AI is that, don't look at it as replacing people, just helping those people get more work done quicker. We want the same amount of humans in the loop. We just want them to get more done in that time.
Here. Well said, that man.
Okay. Next up is the commercial versus financial view. So beyond the numbers, how do you assess the target market's positioning? I know we touched on that earlier. Competitive landscape, customer relationships. How much should this be part of your due diligence scope?
Yeah, like I said, it's not done as frequently and as diligently as it could be done. I think that's largely because, lots of acquirers that aren't institutional acquirers don't necessarily have the resources to do it. I'm seeing a increasing number of like post-merger integration companies that are there to help post the deal, who also are offering pre-deal kind of market diligencing, which is interesting. Yeah, so like it's difficult to do. Certainly, market sizing for more esoteric kind of niche markets can be quite difficult to do. Like you're going to go to your Gartners and your data gardeners and people like that for your bigger industries and to get ideas about CAGR and who the big players are and direction of travel. But for your smaller SMB space, that's a bit more tricky. So I think a competitor analysis is a good place to start. So get the seller to tell you who their biggest competitors are. Get someone in your home team to go and pull the accounts on those competitors. Have a look at whether those competitors are substantially bigger or smaller than the company that you're buying, and try and almost come up with just purely on revenues alone, come up with who the players are and where your target company is sitting in the pecking order. That will tell you hopefully some kind of proxy for market share. Market share is an approximation because you've got these different layers of the value chain, like what's a wholesale price versus a retail price versus a manufacturing price, how far is that brand permeated. But anyway, you look purely at revenues amongst your competitors and you'll get an idea hopefully of where you sit. If budget allows, a small NPS exercise, a net promoter score exercise could be really useful. If you pick off, let's say 10, 20 of the noteworthy existing and potential customers in the space, even if your seller isn't serving them currently, you'd love to know how those stakeholders, how those potential or existing customers rank on an NPS basis, purely the players in the space.
Yeah, that's a great idea.
So canvas for that sentiment and get the sentiment indicator for both the business you're going to buy as well as the competitors.
I think also if you've got one eye on the future, I think having a solid understanding of the competitive landscape is super useful, because you may be looking to do a kind of lateral integration and acquire one of the competitors to get greater market share. And I think having an eye on that from the start might be useful too.
I completely agree. If you're planning a roll up or you're doing a buy and build, this can only be useful down the road.
Absolutely. Okay, so we have gone through the main bulk of this, but let's talk about post-diligence next steps. So once you've identified these issues or opportunities, how do you sort of fold those insights away into final deal terms, price adjustments, earnouts, or at what point do you decide to just walk away?
Yeah, I think DD is largely getting comfortable with the company that you're buying and the risks that they attract. Some risks are deal breakers, as I mentioned, particularly where there's been duplicity or evasion in the process. I think those are things that are fairly difficult to come back from. But actually, if you've just identified that maybe there's more working capital required to weather a potential J curve, and you need to make sure that there's more money being left in the business, or that there's a greater risk that what you think you're buying is dependent on future growth, and that might not be forthcoming. You need to have those conversations, as I mentioned, about how that affects the deal structure, for want of a better phrase. Your road to alpha is going to be impaired potentially, and so some of that risk should be shared by the seller. We are where we are largely because of their efforts. This is a good litmus test again, like with the seller, to determine just how strongly they believe in the robustness and the sustainability of their business. Because if there's a contingent aspect to the deal that is dependent on the company's continued performance, and this is a way to reveal whether the seller really believes that there is going to be a continued performance, right? Because they're going to bet X amount of their exit on it if you attach it to an earnout. A fair earnout. I don't think it's, look, gone are the days of Martin Sorrell and WPP making everything contingent on continued growth of the agencies that he rolled up. That was just chef's kiss. But today people are a bit more savvy, and they're well advised. And so, I think a contingent earnout that is like, look, it needs to do the same as last year or more, or you might even be generous and say, look, 95% of last year or more. But you don't want to be more generous than that, and you don't want to set this needs to double in order for you to get your earnout. That's a bit unfair. No one's really going to agree to that. But something that is somewhere between those poles. I think if the seller truly believes all of what they've peddled to you in this process, that the company is robust and is going to continue to flourish, then they'll take some of that risk on.
Yeah, I think that's a good way of sidestepping the hospital pass, as you put it. If they know that crunching tackle is coming, then they would be so happy on the earnout. So yeah, I think that's a really smart move.
Yeah, fingers crossed. That's a good way of being able to test. So yeah, I think that's all I probably have to say on that matter. Is just use what is revealed in the process in discussion with the seller, and come up with a deal structure revision if necessary that both sides carry some risk in.
Excellent. Well, thank you so much for that, Gareth. I think that was really illuminating stuff. I think I feel more confident to go out and carry out due diligence now. So hopefully our listeners do too.
Great. Well, look, we're trying to give back to the community. We're trying to help empower more SMB succession M&A. Like, it's important that more deals get done. There's too much deal failure during due diligence. So I think often that's a lack of preparation by either side.
On that note, so while we were talking, you mentioned that you have a kind of due diligence checklist. If listeners, if you're interested, then drop us a comment or send us a message and see whether you'd like Gareth to make that something shareable. Obviously, a kind of abridged version of that they can use for themselves. But if that's something that people would find useful, would you be happy to share that?
Yeah, of course. But it's also part of the curriculum sort of assets and resources that you get by participating in the acquisition incubator with BizCrunch.
Of course.
Probably a good opportunity to mention that, I guess, that we have this recently launched 8-week intensive program. It's designed to fully prepare you with all of the tools and capital and knowledge that you need to go from sort of spreadsheet to deal complete, to really complete your first acquisition, get it over the line. We are using the acquisition incubator as a real kind of catalyst to get deals done. We're of the mind that it shouldn't take 2 years to find a good company in this day and age with tools like BizCrunch. So we're seeking applicants at the moment for our cohort of 6 hand-picked, ambitious entrepreneurs, probably business school graduates or career changers out of corporate, people that have got a hunger for operating a business and a hunger for equity in owning a business. We want to help you. And we want you to participate. So come apply. It's at acquisition-incubator.com.
I'll make sure the link is in the description of the video, and we'll share it on all of our socials as well. I'm incredibly excited about this, and I really love it. Feels like kind of putting our money where our mouth is, because we want there to be more acquisition entrepreneurs out there. So why not help shape a new cohort of them, and hopefully they can go out and spread the word and spread it further and further and further, and that's what this is all about.
Yeah, let's get more deals done. Let's get more exits for these baby boomer owners that need to pass the baton on to a new generation.
Absolutely. Okay, well, with that, we're going to wrap up the episode. We'll move to questions for the live audience in the community. Thanks everybody for listening, and as Gareth always says, keep crunching.
Keep on crunching, folks. See you soon.
Bye-bye.